My name is Waffles, and I'm a government whistleblower turned political commentator, and here are the top economic highlights for the past 24 hours. Markets were closed yesterday for the Thanksgiving holiday, so there is no official closing numbers for the stock market. Weekly jobless claims fell to a 7-month low, 216,000 initial claims. This suggests layoffs remain muted even as hiring cools. Economists warn it's a quiet but soft labor market that complicates the Fed's decision calculus on rate cuts. Watch November payrolls delayed for confirmation. The U.S. extended tariff exclusions for a set of Chinese industrial and medical goods. A 1-year extension was announced for a group of products, part of the broader U.S.-China trade truce, easing some near-term cost pressure on affected manufacturers and medical suppliers. That reduces immediate tariff shock for those categories, but leaves broader tariff policy uncertainty intact. Dollar weakness. The dollar is headed for its worst week in roughly 4 months. Market pricing for a December Fed rate cut has increased, and the dollar's slide lowers export costs, but raises imported goods inflation risk, a two-sided trade effect policymakers must watch. Consumer confidence deteriorated in November. The Conference Board's index fell sharply in the latest release, signaling households are more worried about jobs, prices, and their financial situation, a direct downside risk to holiday spending and GDP. Geopolitical trade friction. Indonesia reportedly pushed back on poison pill clauses in U.S. trade talks. Jakarta's rejection of clauses aimed at curbing China's influence shows limits to U.S. leverage in building trade coalitions. A reminder that trade diplomacy remains fragile and can complicate export opportunities for the U.S. Interest rate cut bets intensify, boosting gold and commodities as market price in Fed loosening. As markets increasingly price in a possible interest rate cut from the Federal Reserve, potentially as soon as December, safe haven and commodity assets like gold have surged. That reflects investor anxiety over inflation and currency weakness. A rate cut and weaker dollar could ease borrowing costs and support growth, but also raise import price inflation and erode real interest returns for savers and retirees. Retailers issuing cautious forecasts ahead of holiday season, consumer uncertainty weighing on demand. Several large retail chains have issued cautious earnings holiday season guidance, expressing concern about consumer demand softness as inflation and cost pressures weigh on households. Consumer spending drives a large share of U.S. GDP. Weak demand at retail suggests consumer shock absorbency is waning, increasing risk of broader economic slowdown. Manufacturing sector watch. Durable goods orders remain flat to slightly up, but backlog and inventory indicators suggest soft demand ahead. Recent durable and capital goods order reports show only modest increases, with many firms reporting elevated inventories. That means stuff is backing up in the warehouses, and soft new order growth. This suggests firms may curb future production or hiring. Manufacturing and Business Investment act as a buffer when consumer demand weakens, but that buffer does erode. The risk of contraction or layoffs increases. Construction and housing market signals mixed. Mortgage rates still high, but housing starts data shows some resilience in certain regions. Despite still elevated mortgage rates, housing starts and building permits data in the most recent release indicate some modest uptick in construction activity, especially in the Sun Belt lower-cost regions. Housing construction can support jobs, materials demand, and regional economies. Modest activity may cushion a broader slowdown. Upcoming home sales data, broader sentiment surveys, and regional construction employment figures will be things to keep an eye on if you'd like to track this issue. Stock buyback and corporate cash flow trends signal firms are returning to shareholder payouts rather than reinvestment, a potential long-term drag on productive investment. Corporate reports and analyst notes in recent days show many firms are prioritizing share buybacks and dividends over capital reinvestment, citing uncertain demand and cost pressures. investors. While buybacks benefit shareholders in the near term, over-reliance on them instead of reinvestment can dampen productivity growth, wage growth, and long-run economic resilience. Things to keep an eye on: CapEx, capital expenditures, guidance on upcoming quarter 4 earnings, and aggregate business investment trends over the next 12 to 18 months. Housing starts and building permits data shows modest resilience in some regions. Even with high mortgage rates, regional housing starts and permit data have held up in Sunbelt and lower-cost metros. Some analysts interpret this as a sign that housing demand hasn't fully collapsed, offering a partial buffer against a broader economic slowdown. Housing contributes to jobs, materials demand, and local economic activity. Modest strength here helps cushion other weak spots like consumer spending and manufacturing. Durable and capital goods orders remain mixed, some pickup, but firm caution on backlog. Business investment surveys and recent capital goods orders show only modest gains, and many firms are reporting high inventories and weak new order flow, indicating caution. When firms delay or cancel equipment orders, it can signal broader investment weakness, which often precedes slower production, hiring freezes, or layoffs. Corporate behavior shifting, more firms opting for buybacks and dividends over new investment. Recent corporate earnings reports and financial market commentary show some companies returning cash to shareholders via buybacks or dividends rather than reinvesting in expansion, citing cost pressures, demand uncertainty, and global supply chain risk. While this rewards investors short-term, over-reliance on buybacks can undermine long-term productive investment, wage growth, and the economy's capacity to grow sustainably. Emerging stress in import price pressures and input cost inflation risk. With a moderately weaker dollar and lingering supply chain bottlenecks globally, import price indices and input cost measures are showing upward pressure, a headwind for manufacturers and consumer goods producers. Higher import and input prices can squeeze corporate margins, prompt price hikes, and erode consumer purchasing power, creating stagflation risk if demand is weak. Financial markets show fragility. High yield spreads and volatility remain elevated. Recent market commentary points to widening corporate bond yields and elevated volatility, suggesting that credit conditions may tighten, especially for higher risk firms. This could constrain business investment and increase borrowing costs for households and companies alike. Tighter credit raises financing costs, discourages borrowing and investment, and can lead to defaults, which will ripple through employment, real estate, and consumer sentiment. Producer Price Index, the PPI, wholesale price inflation for goods and services. PPI shows inflation pressure upstream, wholesale, or producer level. If PPI rises over several months, consumer price inflation, CPI, often follows with a lag, squeezing margins for producers and purchasing power for consumers. That's something to keep an eye on. Import price index is another thing to watch. Why it matters: it reflects how import costs are evolving, raw materials, components, and finished goods. With a globalized supply chain, higher import prices feed into consumer inflation and business cost pressures. Durable goods orders and shipments and capital goods orders, ex-defense and aircraft, are also things to monitor. Durable goods orders, especially non-defense, non-aircraft core capital goods, provide a snapshot of business investment and demand for long-lived assets. Lagging shipments data and backlog and inventory levels reveal whether businesses are actually following through, helpful for assessing momentum or stagnation in industrial activity. Industrial production and capacity utilization. This measures actual output of factories, utilities, and mines. Because production often adapts slowly, these are lagging signals of industrial health, resource utilization, and business cycle phase. Corporate capital expenditures, CapEx, business investment from national accounts. These are another thing to keep an eye on. Long-term investments by firms in equipment, structures, and intellectual property matter for productivity growth. Changes in CapEx often reflect past corporate profitability and demand and shape future growth potential. Persistent weakness signals a shrinking capacity investment base, which may depress long-run growth. Trade balance and current accounts balance, goods and services trade data. This is another thing to watch. There's things to watch. Reflects cumulative trade, import and export performance, sustained deficits or surpluses, influence exchange rates, foreign capital flows, and external vulnerability. Widening deficits over time may signal domestic demand weakness or structural competitiveness problems. Household savings rate, personal savings, and disposable income from BEA data. These are things to watch. Tracks how much of net income households actually save, a buffer against economic shocks. A falling savings rate after prolonged inflation or wage cost pressure reveals household vulnerability and risk to consumer spending-driven growth. Corporate profit margins and debt to earnings ratios. These are another thing to watch. This shows how companies are coping with costs, debt burden, and revenue pressure. Margin compression or high leverage often presage. I don't even know what that word is. What is that word? Presage. Presage of an event to be a sign or warning that something typically bad will happen. This is corporate profit margins and debt to earnings ratios. Are the companies going in debt? Are they making profit? Is their profit decreasing and debt increasing? How far is the gap between debt and profit? This shows how companies are coping with cost, debt burden, and revenue pressure. Margin compression or high leverage often presage, indicate something bad is going to happen. Cutbacks being the thing bad that would happen in hiring, investment, or even defaults, a sign ahead of financial stress. Bank lending standards and credit conditions. Senior loan officer surveys, BIS data, these are things to watch. Tightening credit conditions often lag economic stress but amplify downturns. If banks restrict lending, small businesses and consumers may struggle to finance operations or consumption, exacerbating recession risk. Long-term unemployment duration and unemployment rates, another thing to watch. U.6 rate, why it matters. While headline unemployment may lag overall economic conditions, longer-term unemployment and underemployment reveal persistent labor market slack, especially after shocks. These rates signal deeper structural weaknesses affecting income, consumption, and social stability. So then, see, we just had a holiday and the market's been closed and everything, and the government's not really been doing much because of the holidays, so there's not much to report right now on economic movement. But we are waiting for data to be released at the beginning of December on a variety of fronts. Data that should have been published a while ago that was not as a result of the shutdown. And so what I feel like I'm seeing in this is things are stalling out. A lot of people, it's kind of like a tense moment where we're all just waiting to see what's going to happen and trying to get by. And that means civilians, industries, and businesses, be they small or corporate. As a result of where our economy is currently at because of the tariffs creating global economic uncertainty, acts of war from multiple countries, being Russia and, the U.S. attacking and threatening multiple nations, international relations with who's hanging out with each other, and inventories are starting to pile up. People are not buying right now. And there's concern over whether or not consumers are starting to run out of savings. Meaning that the economy is slowly drifting downhill. I mean, technically it looks to me like it's quickly going downhill. But when you look at the big picture of the chain of connection between consumers to business to global economy, it's as though there's a slow domino effect that is starting to take place here, where things are starting to stall out, stagnate, and slow down. People are not buying, businesses stocked up because of the tariffs. I'm just assuming that this is what's going on. And they have stuff piling up in warehouse because consumers are not purchasing goods. Other than that, I would assume nobody even knows who to trade with right now. So anybody in manufacturing in the United States, like, their resources are being tampered with, and we're supposed to be somehow becoming an export-based economy when we're cutting off the supply to the manufacturers through the tariffs? So inventories are kind of slowly starting to pile up. Probably because of overstocking and then consumer demand going down. Housing costs are unrealistic. And it's having an impact on industries like construction and other areas of the economy. And then other than that, we've been following the story of Apple, which has been engaging in what appears to be human rights violations. They are being sued for how they are treating employees abroad. This is a U.S.-based company. Just trying to do a recap on the kinds of things that we've been keeping an eye on over here in regards to the economy. Like I'm just, what's going on in my head is like, where are we at on like stagflation? I mean, to be frank and short about it, what it looks like to me is everybody's holding on to their hats, just like waiting while dumbass Donald Trump fucks up the global economy, and everybody's just kind of on pause, waiting to see what's going to happen here. That's what it looks like to me. That'll be on the business side and the consumer side. That's what I feel like I'm observing with these economic reports. Other than that, the economy is doing this, and I don't even know why anybody's putting any money into anything right now. And I'm concerned about market manipulation due to the way that the fluctuations have been panning out, where it's like when there's massive drops, there's all of a sudden an equivalent increase, which essentially has also been keeping the stock markets stagnated. So I guess the way that I would describe the economy, the overall outlook, the grander picture, is that everything is stalling out. There are increasing signs that the U.S. economy is flirting with a kind of stagflation-light scenario. It's not a full-blown 1970-style stagflation yet. Here's a breakdown of where things stand. Inflation remains stubborn while growth slows. Annual inflation recently edged around 3%, with key price pressures, energy goods, and shelter still elevated. At the same time, real economic growth is modest. Forecasts for 2025 hover in the 1.5 to 2% range, well below pre-pandemic potential. We still have not recovered the economy from the pandemic. We still need to recover the economy from the pandemic, and Donald Trump's out here just like, tariff this, tariff that, I want all the money, I'm going to take everybody's money through the tariffs. And we still haven't recovered from the pandemic yet. So we're looking at indicators of stagflation, labor and job growth weakening while layoffs remain muted. Hiring has cooled. Private sector and survey data suggest slackening labor demand. Some forecasters describe the environment as stagflation light, growth too weak for comfort, but inflation too high to ignore. Policy and structural headwinds, tariffs, trade friction, and supply side pressure, ongoing trade and tariff disruptions, shifting supply chains, and geopolitical uncertainty are contributing to elevated costs for many goods, which tends to show up as inflation even if demand is weak. Some analysts argue that this structural disruption is part of why growth and inflation are decoupling, an iconic hallmark of stagflation-like settings. Consumer pressure, sentiment, and spending fragility surveys show consumer confidence has dropped sharply, with households worried about costs, employment, and income prospects. Retail sales and consumer spending have cooled, especially among middle and lower income households, reducing a key support for economic growth. Unclear help from policy. The central bank signals show tension. Cutting rates could help growth and employment, but risks fueling more inflation. Policymakers are increasingly wary that easing monetary policy might conflict with inflation control. Because of these pressures, especially the combination of elevated inflation and slowing growth and weakening hiring, many economists now describe conditions as stagflation light rather than outright stagflation. Why it's not classic stagflation yet? Big caveats: employment and output haven't collapsed. Unemployment remains moderate, hiring continues, and no mass layoffs so far, unlike classic stagflation episodes where unemployment skyrocketed. Output is still growing, a bite, modestly, not contracting, so slow growth. Inflation is not runaway. While inflation is above target, it is far from the double-digit wage price spiral. Inflation of the 1970s. Many forecast the inflation gradually easing toward more moderate levels in 2026, assuming no fresh shocks. Yeah, like that's going to happen. Donald Trump's already trying to find new legislation to use to try and introduce more tariffs since he's being checked by the courts. So, good luck, 2026. Some signals even suggest a mild deceleration in price pressures. Inflation has not run away, but it is extreme. One of the things I see people complaining a lot about is the cost of coffee. Like $20 for a can of coffee. Isn't that like a 50% increase on the cost of coffee? I don't know, I'm just throwing numbers out there that seem to be about appropriate. So what is happening with the tariffs is that certain consumer goods that we would normally be purchasing are being impacted, like coffee. Things that people consider staples and regular consumption items. So then I personally would say that inflation is runaway when it comes to certain consumer goods. And because of the fact that we're looking at staple products, then it is runaway depending on what you buy. So then what I'm reading is implies that if you change your consumer habits, and that means like doing things like, for example, cutting out nicotine in coffee altogether, because, and I'm not saying that nicotine is just an example, like habits and things that people just consider routine behavior. That would be a normal part of a person's day. You know, your coffee is something people are complaining about. And it's not something that I expect that people would just get rid of because it's like something that a lot of people kind of lean on to function. I just think it makes a good example. If you were to get rid of those things and, you know, alter, depending on where you are doing your money, you would be more likely to kind of float through this. But I also don't think that's realistic because, like I said, human beings, you know, we're going to buy eggs, we're going to buy milk, we're going to buy freaking coffee, okay? We're not just going to go fucking start living off of, you know, bags of chips because that's what's affordable. And I'm not saying that chips are affordable, but I'm just trying to make a clear example of what kind of exchange the current economy is expecting from consumers at this time. And why it is that we're being impacted so heavily by inflation and why it's pissing people off so much. What this means globally and why stagflation risk is global, not just U.S. Because the U.S. remains a dominant consumer and importer And because global supply chains are tightly linked, any prolonged U.S. stagflation-like environment tends to ripple worldwide. Investors are already factoring in the risk. Elevated U.S. inflation, slowing growth, and possible policy missteps can contribute to global bond market volatility, pressure emerging market economies, and tighten global credit conditions. At the same time, some economies might benefit, e.g. commodity exporters or nations with more stable currencies, but overall the uncertainty caused by the tariffs reduces global investment, trade, and growth momentum, as well as acts of war caused by the tariffs and acts of war, which, ideally it would be a good idea if Donald Trump would just hit the brakes on everything he's doing economically, put everything back where it was when he first got into office, and quit fucking with shit. The longer this goes on, the more likely we are to stabilize and fix our relationships with foreign nations. And he needs to stop bombing people and stop giving money to people who are bombing innocent civilians. It doesn't look good. And it doesn't make anybody want to do business with the United States. And the whole global economy can just go elsewhere. And then we're fucked. Because we are not set up to be isolationists. If we're going to try and become an isolationist nation, providing our own goods and becoming major exporters, that is going to take time to transition into being that sort of economy. And we don't just flip switches overnight and expect everything to suddenly be magically fucking different. And this is why the economy is going to shit. Because Donald Trump lacks tact and skill, and is a horrible negotiator. The current U.S. economic state is on the cusp of stagflation, but in a softer, more manageable form. It's not yet a deep crisis like the 1970s because we don't have collapsing output or mass unemployment. But the combination of sticky prices, sluggish growth, and labor market deceleration, along with trade disruption and uncertain consumer confidence, is enough to qualify as stagflation light. It's like having a miniature Game Boy. If negative shocks accumulate, tariff spikes, energy price surges, global supply chain disruptions, and policy mishaps, the risk of slipping into a more severe stagflation or even a recession becomes significant. So then, rather than spending $73 million of taxpayer money, which is just $25 million short of $1 billion, that money could be better spent on infrastructure and programs. And if we're going to try and shift the United States economy, that would be exactly what we need to do, is put funding into altering the structure of the economy by assisting manufacturers if we're to be trying to be an export-driven or self-sustaining nation, because we are currently not set up for that. So then what the president should be doing is taking the money that he's spending on golf trips, if he's trying to follow through with this lie that we're trying to become, the export-driven and isolationist. I'm not supporting the idea of structuring the economy that way, but if that was even what the president was trying to be doing, if he were to be effective at it, because he's shitty at his fucking job, what he should be doing is putting money, taxpayer funds, into infrastructure projects and giving people jobs and not laying off the entire fucking government. Alright, well, let's close out by trying to solve the world's problems. Let's see if we can solve the world's problems. If we wanted to recover the economy from where it was at during the pandemic, stabilizing the U.S. and global economies and delivering inclusive growth that helps households, small businesses, and emerging markets from the pandemic shockwaves. This is U.S. and global. It would mean stabilizing demand where it's weakest, households, small firms, hard-hit countries. while repairing supply-side bottlenecks and investing heavily in green, digital, and human capital infrastructure, all underpinned by international cooperation on debt, trade, and macro frameworks, so growth is broad, resilient, and equitable. Real quick, let's just take a moment to stop and reflect on these things. Donald Trump is choosing not to be involved in the World Economic Forum that's taking place right now, the G20 summit. We are trying to bring the world out of a pandemic. We just had a global pandemic and the economy is not improving, and a huge chunk of that is right now because of Donald Trump. And he is refusing to go speak with the multiple nations to try and collectively figure out how to fix this. So world nations right now should have reason to want to be meeting, to be discussing, why it is that the economy is stagnating, and a chunk of that is because of Donald Trump and he's not there. This is not going to help the United States in the long run. This is going to put us in a really bad situation because nobody's going to want to fucking do business with the Americans. He should be participating because we have a global problem. Being the world economy in a bad state right now after a pandemic, and he's not choosing to help. Let's not forget about the things that happened like fucking yesterday. The pandemic, Trump's pandemic, is one of those things. So, this is a space right here where nations should be working together because we have a global problem. And we need to do these things. Stabilize demand where it's weakest, households, small firms, and hard-hit countries. That's going to include Africa. And be investing in these places. And trying to improve the economy. And this is something that we could coordinate internationally. But Donald Trump's, when he comes to the table, it's just me, Donald Trump. Everybody give Donald Trump your money. That's literally the economy right now, the global economy. Because he has tariffed half of the planet. And he's not choosing to participate or negotiate. So therefore, because of his inaction and inability and refusal to negotiate, then he is a bad negotiator. And that's what needs to be done right now. Nations need to be sitting together at a table trying to negotiate, find reasonable and rational solutions based on what is actually happening in the world. Core pillars and why they matter. Targeted fiscal support. This is what it would look like if we were to fix these problems. Targeted fiscal support plus credible medium-term consolidation. Targeted transfers, extended unemployment support, small business loans and grants to prevent scarring, permanent job losses, and bankruptcies. In the medium term, this would mean clearing fiscal plans to stabilize debt dynamics, growth-friendly consolidation once recovery is assured. This preserves market confidence and space for shocks. Monetary policy plus coordination, keep the central bank independence, prioritize price stability, which we do not have right now because Donald Trump just keeps introducing tariffs. And it's like this with whatever you're going to buy at the grocery store. 1 week tuna's $1, the next week tuna's $3 fucking, and is 2 weeks later it's the cost of a steak to buy a can of tuna. Taco Bell and Chipotle are the same price, but you get a better quality product at Chipotle. Technically, Chipotle should cost more. It did cost more, and now because of the way that the supply chain's being managed, what is low-end fast food is incredibly expensive. If you want one steak at the grocery store, one meal, a steak, is $20 for one steak. You don't get to eat steak anymore. Monetary plus coordination. Monetary policy plus coordination. Prioritize price stability, credibility. Here's the instructions for Donald McDumbass on how to fix the economy. Stabilize the prices of goods. Take your tariffs and shove them up your fucking ass. But communicate clearly about sequencing of easing so markets don't misprice inflation risks. Coordinate with fiscal policy, e.g. temporary targeted fiscal support while monetary policy tightens to avoid either overheating or suffocating demand. These are instructions on how to fix the global and the United States economy. Invest in green and digital infrastructure, high multiplier jobs and future growth. Public investment to modernize grids, expand broadband, retrofit buildings, EV charging, clean energy projects with de-risking tools to attract institutional capital. These projects create jobs and raise long-term productivity. Things like solar panels, which I don't give a damn what kind of energy you support. Solar panels, having something that just sits there and literally collects energy for free, is a lot more efficient than gas. It's less expensive. Strengthen social safety nets and active labor market policies. Expand retraining, apprenticeships, wage subsidies tied to upskilling, child care support, reduces unemployment duration, and improves inclusive participation. Evidence shows active labor policies reduce scarring and inequality. Yeah, it would be great if there was actually like job programs attached to like unemployment and stuff. You see, what happens is the economy ebbs and flows and it changes and it upgrades and it updates, and sometimes somebody's education might become outdated. And what should be happening if our government was functioning would be reskilling of individuals who have been pushed out of the markets on labor. So, part of the reason why we have a Department of Labor is to keep people working. The whole reason why we have an unemployment program is to take people who otherwise would not be functional due to not having a roof over their head, not being able to afford basic necessities, all due to a temporary job loss situation, and keep those people functioning in society by not having things like their phone bill lapse, so then they can go and get a job. And reskilling is something that could be used and be very helpful in a growing and expanding economy and a changing world to keep members of society functional and useful towards the nation's GDP. So that is, strengthen social safety nets and active labor market policies. First of all, by taking away those safety nets like food stamps, housing programs, etc., then what you have is a person who otherwise would be useful in the nation's economy, living on the streets, not being productive, and struggling to even find a place to shower. It is not effective to have people living outside. Those are all people who could be helping improve the economy after a pandemic right now. And instead, what this administration is doing is they're trying to, first of all, violate our constitutional rights and enslave people, which is fucked up and wrong. And like I said, these people are creepy and weird, and I don't think they're special, and I don't think that Donald Trump and his MAGA buddies are any more deserving of the right to have, first of all, to be alive, and to have any form of peace or happiness. I don't think that Donald Trump and his buddies should be the only people on the planet Earth allowed to have a functional life. It is 2025. This is not the 1800s. Can we grow past barbarism and start becoming a functional, civilized society? That would be great. That means not defunding our federal agencies. The Department of Labor, food stamps, etc., those keep people being functional members of society rather than waiting in line for a shower. By defunding these programs, the only thing that he's doing is taking a massive chunk out of the United States economy. There is a reason why we have these programs. Back to solving the world's problems, trade predictability and supply chain resilience. Shift from ad hoc tariff shocks. Get rid of the fucking tariffs, dumbass. You're pissing the whole world off. Towards predictable trade rules, targeted supply chain resilience measures, diversification, onshoring where strategic, and export support, reducing imported cost shocks and uncertainty that depresses investment. Donald Trump is currently taking thousands of people out of the workforce Not just in our federal agencies, but he's screwing over Americans, you know, getting rid of this DEI stuff. A lot of black people have lost their jobs and shit. Women are facing financial insecurity during this time. The only people who are probably in a functional state right now are likely white men. I'm not trying to be racist, but according to what's been happening, due to the fact that what we seem to be observing is a racist agenda, the only people who have any form of stability are probably those people. And because of that, those people who are assholes and trying to oppress us all, probably do not have a realistic understanding of what is going on in the world around them. And there is literally thousands upon thousands of people being removed from the United States economy right now as a result of what Donald Trump has been doing by destabilizing the nation's economy, defunding our federal agencies, fucking up our federal programs, fucking up the way that the country functions, introducing tariffs so he can literally loot half the planet and think that he's some sort of mystical fucking gold fairy. And what we should be doing is running our fucking government, because there is a reason why we have the programs that we have and the services that we have. We pay taxes for a reason. Our taxes should be used to improve the welfare of the people of the nation. The United States has 350 million people. China has 4 billion people, and people in China have a higher standard of living than the people in the United States, which only has a small fraction of the population that China has. We have a problem here. Our government is not doing its job. Why the fuck are we paying taxes? Trade predictability and supply chain resilience. Quit fucking with people's ability to predict the market by trying to manipulate the market so you can steal from people. These are solutions to fix the economy. Give this to Donald Trump. He's just stealing money, you guys. At the detriment of not just the people in the United States, but all across the world. That's what this tariff shit is. These are unallocated funds that they can just be like, I want to spend it on this, I want to spend it on that. We don't even have adequate protection from storms and weather events. And it is 2025. Our government has the audacity to tell us that there's an alien invasion taking place, yet our technology is so fucking lackluster that we can't even protect people from a fucking tornado. So stop stealing from everybody before you wind up in jail, Donald John Trump. Shift from ad hoc tariff shocks. You're shocking the economy. Stop doing that. Shift from ad hoc tariff shocks toward predictable trade rules, targeted supply chain resilience measures, diversification, onshoring where strategic, and export support, reducing imported cost shocks and uncertainty that depresses investment. It makes it so that people are not spending money and money is not flowing, and so the economy is like a freaking assembly line where the belt is broken down right now. Global financial architecture and debt treatment. Speed up credible sovereign debt restructuring frameworks, liquidity support, IMF and World Bank, and targeted concessional finance for low-income countries to prevent crises that spill back on advanced economies. Support for productive investment and competition. Incentivize corporate capex. Tax credits for green and digital capex. Support SMEs' access to credit and enforce competition policy so gains are widely shared. Concrete policy menu, actionable items, immediate, in the next 3 to 6 months, stabilize and protect, extend targeted unemployment and food assistance for vulnerable households, expand temporary tax credits for low-income earners, fast funding lines and grants for small businesses tied to rehiring and capex. Quit attacking small business to try and favor your corporate bigwig buddies in big tech and retail. Short emergency liquidity windows and conditional loan guarantees for emerging markets. Press for faster common framework debt treatments where needed. Medium term, 6 to 24 months recovery and retooling. Pass medium scale public investment packages found on clean energy, broadband, and retrofits with matched training programs. This creates jobs now, productivity later. Use public-private de-risking instruments to mobilize pension and insurance capital. Launch large-scale upskilling and apprenticeship initiatives in partnership with employers and community colleges. Tie hiring subsidies to training competition. Reform tax code to reward productive investment and close loopholes that favor buybacks. Gradually widen tax bases to fund long-run social investment. This is what the president should be doing if he was trying to help the country right now. Structural and long-run, 2+ years, deep reforms in global debt architecture, clearer timelines, faster treatments, and better coordination among officials and private creditors. Increase concessional finance capacity for climate and resilience. Strengthen R&D supports and competition policy to boost business dynamism and broad-based productivity growth. Sequencing and trade-offs. Do fiscal first, but targeted. Broad, untargeted stimulus risks higher inflation. Targeted support protects and the vulnerable and prevents long-term scarring. Monetary credibility must be preserved. As central banks lose anti-inflation credibility, long-run costs rise. So pair stimulus with a clear, medium-term fiscal anchor. De-risk public projects to crowd in private capital. When public budgets are constrained, public sector de-risking guarantees green banks, for example, unlocks large private pools for infrastructure. Metrics to watch, early warning and success signals. Employment, unemployment rate, and medium unemployment duration for labor force participation. How long people are unemployed and how many people are involved in the labor force. Inflation composition, core CPI, import price index, PPI, and shelter inflation. Business investment and CapEx orders, durable goods shipments. Sovereign debt stress indicators for emerging markets and G20 common framework throughput. Credit spreads and bank lending standards, financial conditions check. Quick wins, what legislators and executives can do fast. Extend or temporarily expand refundable tax credits for low-income families and child care subsidies. Put the protections that were there back where they were before you got into office. These are instructions for Donald Trump on how to fix the economy. Accelerate permitting for shovel-ready green and broadband projects and fast-track small business grants. Convene a high-level G20 task force to operationalize faster debt relief contingent liquidity lines for vulnerable countries. Sit your ass down at the G20 and participate in the global economic hearings, dumbass. Why this package that we are introducing here today reduces stagflation risk, targeted demand support, prevents mass unemployment, reducing output collapse without overly broad stimulus that revives inflation expectations. Supply-side investments, lower costs over time, energy, transport, digital, removing the structural causes of persistent price pressures. Global debt and trade cooperation prevent spillovers and financial sector contagion. These three channels together tackle both sides of stagflation, demand shortfalls, and supply side cost pressures, risks and pitfalls to avoid overly protectionist trade moves, like trying to make the United States an export-driven economy when it's not set up for that. Overly protectionist trade moves that add input costs and global fragmentation. That also includes Donald Trump's tariffs that are being used to literally loot the planet. Relying solely on monetary easing while neglecting structural reforms can fuel inflation without boosting potential output. Short, shareable elevator summary, one paragraph. Stabilize the recovery by protecting households and small firms now with targeted fiscal measures while investing in green and digital infrastructure and retraining programs that boost jobs and productivity. Pair short-term support with credible medium-term fiscal anchors and international cooperation on debt and trade so growth is shared, inflation is contained, and future shocks are less damaging. That is how you fix the United States and the global economy. In a nutshell. And a summary of what Donald Trump is doing wrong versus what he should be doing. This concludes today's economic report. I'm going to go now on to the next thing. I'll see you guys later. Bye-bye.
So the Olympics is great. And Johnny, for the others, the World Cup, Johnny is the head of it. We had our top people, Wasserman. They all came in on the Olympics, and then I saw Johnny. And we got the World Cup, too. And, it's only because they rigged the election that I'll be your president representing you there. I got both of them. I got the Olympics and I got the World Cup. And I said, it's too bad. One was in 2026 and the other was in 2028. And I said, I won't be there. I won't be your president. But then they rigged the election and now we won. So I'm going to be your president for the Olympics and for the World Cup. So, Johnny, thank you for the World Cup, and everybody, thank you for the Olympics. We're going to have a great time.
Hey, guys, don't forget to like, share, subscribe, and comment on my videos. And also, don't forget to check out my shop where you could get this awesome Real Patriots, Punch Nazis t-shirt. America, fuck yeah! And if you go to the link tree in my bio on most platforms, it's got links to everything, all of my stuff. You can find my shop there. I'm on eBay. You can also get this cool Exterminate MAGA sticker, because MAGA's fucking cockroaches. And fuck MAGA, abolish MAGA, fuck you MAGA.